Welcome to the deep dive. Today we're jumping straight into, well, the high-flying world of aerospace.
Right.
And specifically, a company like GE Aerospace. This is a titan. Its engines power a huge chunk of the world's aircraft, commercial, and defense.
Absolutely massive scale.
But how do you really get a handle on a company this complex? Especially, when you're looking at it through a stock analysis lens.
It's a challenge. There's a lot going on there.
So our mission today is pretty straightforward. We're going to take a deep dive into the source material we've gathered on GE Aerospace, that symbol GE.
Yep. GE.
We're here to pull out the key insights, the important stuff, really, to give you a shortcut to being genuinely well-informed about this major player in industrials, specifically aerospace and defense.
We'll unpack where it stands now, its core strengths, and also the challenges it's facing. It's not all smooth flying.
Exactly. And we've got a mix of sources, financials, analyst reports, recent news, trying to get that comprehensive picture.
Good foundation.
Okay, so to ground us, let's get to basics. What exactly is GE Aerospace at its core? Can you give us that quick snapshot?
Sure. Well, at its heart, it's an American company making aircraft engines, jet engines, turboprop engines. Their business is kind of split into two big segments: commercial engines and services, that's the really big one, and then defense and propulsion technologies.
Okay.
And they own some well-known brands, too, like Avio, Aero, and Unison. It's a fundamental piece of global aviation, really.
Got it. And the market right now, what's the immediate picture looking like?
Well, okay, so the last close was $260.28 USD, though worth noting, it did dip a bit that day, about $5.90, or 2.22%. The market cap is huge. $277.56 billion, just massive.
Wow.
For anyone tracking dividends, it pays $1.44 USD annually. That yields about 0.49%. Payout ratio is pretty low, 15.70%.
Okay.
And next earnings release, you'll want to mark October 28, 2025 on your calendar. Oh, and the 52-week range is pretty wide, $150.20 on the low end, up to $272.80.
Right, and here's where it gets, interesting right off the bat for us. That current price, $260.28.
Yeah.
It's actually quite a bit higher than what our sources are citing as a fair value. That's $220.37. And it's also above our price target of $205.18.
Ah, okay. So there's a gap there.
Yeah, it immediately sets up some, tension around the valuation, doesn't it?
It absolutely does. And that tension, that valuation question, it stands in, interesting contrast to something analysts call an economic moat.
Right, the moat.
In investing, a moat is basically a company's sustainable competitive advantage, what protects its long-term profits. And GE Aerospace, it actually has a wide moat rating.
Wide. That's the top tier, isn't it?
It is. It signifies a really strong, durable advantage.
So what drives that? What gives GE Aerospace such a wide moat? You mentioned their installed base earlier.
Yeah.
Something like 70,000 engines globally.
Exactly, around 70,000. That number is staggering.
But what does that really mean for the bottom line? How do they leverage that huge fleet beyond just selling the engine up front?
Right, that's the key. It's not just about the initial sale. The real genius, the engine of their value, if you will, is the aftermarket services. That huge installed base transforms each engine sale into this multi-decade revenue stream, almost like an annuity.
Ah, okay. Maintenance parts?
Exactly. We're talking about a commercial services backlog, just the committed future service work exceeding $140 billion. That's out of a total backlog over $170 billion.
Wow, $140 billion in services alone.
Yeah, it's predictable, it's high margin, it's like a maintenance monopoly. Once an airline chooses a GE engine platform for a plane, they're effectively locked in for decades.
Decades? Why so long?
Well, think about the life cycle of an aircraft engine. It's measured in decades. And the relationships are deep.
Yep.
Switching engine providers on an aircraft platform, it's incredibly complex, prohibitively expensive, creates these massive switching costs.
So once you're a GE customer for a certain plane,
yeah,
you're kind of stuck.
In a good way for GE, yes, you're really in. And they don't just sit back either. They invest heavily, around $3 billion a year in R&D.
$3 billion annually.
Keeps them ahead technologically. Plus, they're making strategic investments, like $1 billion into U.S. manufacturing capacity to meet future demand. All this builds significant barriers to entry. It's tough for anyone else to catch up.
Right. It's not just what they have, it's what they keep doing.
Precisely.
And we've seen this moat pay off recently, right? Some big business wins.
Yeah, absolutely. They just sealed a deal with SkyWest for their CF-34 engines and a massive agreement with Qatar Airways over 400 GE9X and GenX engines. That was actually noted as the largest wide-body engine deal in GE Aerospace history.
Biggest ever. Okay.
Plus, they got clearance to resume sales to China's Comac. That's a huge market opening back up.
Okay, so we got the picture. What they do, this formidable competitive edge, the moat. How does that translate into the cold, hard numbers? Let's dig into the financials.
All right, so looking at the trailing 12 months, revenue hit $41.61 billion.
$41 billion, okay.
Net income was strong too, $7.76 billion. And the margins look really healthy. Gross margin, 37.92%. Operating margin, 18.76%. Net profit margin, 18.64%.
Those are pretty solid margins.
Very solid. And return on equity, which kind of shows how efficiently they use shareholder money to generate profits, a robust 40.51%.
40% ROE.
Yeah.
That's impressive. What about cash flow and the balance sheet? Because, profits are one thing, cash is another.
Good point. So free cash flow, FCF, over the trailing 12 months was $5.63 billion. That gives an FCF yield of about 2.03%.
Okay.
But what really stands out is the balance sheet strength. Look at their cash and short-term investments, almost $11.9 billion.
$11.9 billion in cash.
Now compare that to total debt, just $1.89 billion.
Wow, tiny debt load relative to the cash.
Exactly. That results in a really strong net cash position of nearly $10 billion. That gives them enormous financial flexibility.
10 billion net cash. Okay. And things have been going well recently, too. Didn't they just report earnings?
They did. Q2 2025 earnings came out July 17th. It was a beat on both earnings and revenue.
A beat? Good sign.
Yeah, and it led them to actually lift their full-year outlook for sales and profit. So confidence is high internally.
And what about shareholders? Are they seeing returns?
Definitely.
Yeah.
The company plans to return over $8 billion in cash to shareholders just in 2025. That's through dividends and share buybacks. They recently declared a quarterly dividend of $0.36 per share, too.
Okay, so financials look pretty robust overall. Strong performance, good outlook, returning cash.
Yeah, the picture is largely positive on the financial front.
But, of course, no company is perfect, even one with a wide moat. Where do the counter-arguments come in? What's the bear case here?
Right, there are definitely challenges. The big one everyone talks about is the supply chain. Still, persistent constraints are impacting delivery speed, getting spare parts out. It affects the whole industry, and GE Aerospace isn't immune.
Okay, supply chain issues. What else?
Tariffs. There's an anticipated net cost impact of around $500 million in 2025 just from tariffs. They'll have to manage that.
$500 million. That's not insignificant.
No. And analysts also noted a slightly more, let's say, cautious outlook on aircraft departures, particularly in North America for the second half of the year.
Fewer flights might mean.
Potentially fewer engine shop visits down the line. Now, that massive backlog provides a buffer near term, but it's something to watch.
Okay, so backlog helps, but still something to keep an eye on.
Exactly. And finally, while things like building up inventory and spending heavily on R&D are strategic, maybe even necessary.
Right, for the long term.
They do use up cash now. It impacts that short-term financial flexibility we talked about. Good investments, but they consume resources today.
Got it. And this kind of brings us full circle back to that valuation puzzle we mentioned right at the start.
Yeah, the high multiples.
When you look at those ratios, the price to earnings TTM is 36.26. The forward PE is even higher, 46.32. Price to free cash flow is nearly 50 at 49.32. Price to book is 14.7.
Those were definitely elevated numbers.
They look quite high, especially compared to those lower fair value and price target figures we saw earlier. It really shows how different people can look at the same strong data and come to different conclusions, maybe depending on how much weight they give those near-term headwinds versus the powerful long-term moat.
Absolutely. It highlights that disconnect between current valuation and, say, intrinsic value estimates.
So what does this all mean for you listening in? This deep dive hopefully gives you a more, nuanced view than just a headline.
Right. You've seen a company with this really formidable competitive advantage, that wide moat, and strong recent financial performance. But at the same time, it's facing real headwinds, supply chain, tariffs.
Right. The aha moment here, maybe, is seeing how evaluating a company like GE Aerospace means balancing that impressive long-term strategic position and solid financial health against these immediate operational hurdles and, frankly, the current stock price.
Yeah, and perhaps the key thing that often gets missed in just looking at short-term market noise is how that massive installed base really works.
Go on.
It fundamentally turns every engine sale into this multi-decade stream of high-margin service revenue. It's like an annuity. That's the real engine of its value.
The maintenance monopoly.
Exactly. So temporary dips from supply chain problems, maybe they're more like blips than a fundamental threat to that long-term compounding power.
That raises the big question then. How much do these near-term obstacles really matter for the long-term investment thesis, especially when a company has such a clear, wide economic moat?
It's the core debate for investors here.
So as you think about GE Aerospace, consider how that consistent, heavy investment in R&D and manufacturing, combined with its unique market position, those high switching costs, how that might shape its path forward.
Even with the current supply chain and tariff issues.
Right. What does this mix of long-term vision and short-term hurdles really signify? Not just for GE, but maybe for the whole aerospace industry. It's something to ponder.
Definitely food for thought.
So if you found this deep dive insightful, if it was valuable for you, imagine what more we can uncover together on other topics.
Yeah, lots more ground to cover.
Don't miss out on future insights. Make sure you hit that subscribe button and ring the bell icon too. That way you get notified when we drop our next deep dive.
It really supports our mission here, helping you get well-informed quickly and thoroughly.
Thanks for joining us.